thank you for joining us today. My name is Wayne Frederickson. I'm the Regional Manager with DisNet. DisNet's the online brokerage division for the Desjardins Financial Group, and we're pleased to sponsor the Stockscores Canadian Active Trader Expo. This is the second of 4 stops of this tour. Last week we were in Calgary, had a great event there. Now in my hometown, beautiful Vancouver. And next week we're blasting off, doing this back east in Toronto and then Montreal. At DisNet, we're committed to providing our clients with the best education, investor education, and the most powerful trading tools. And that's why we sponsor events such as this. To those of you out there that are our clients, we want to thank you for your business and your continued support. And for those of you that are not our clients, we put together an unbeatable opportunity and promotion, and a card such as this that you would have got when you came in the door details that we've got representatives from DisNet. They can answer any questions, get you signed up for an account. We also have somebody here, Carrie Ann. You want to stand up? Carrie Ann is here, and she will answer any questions you may have about the live Stockscores course you're going to be hearing about, and get you registered for that as well. We have a lot of information to cover today, and so we're going to begin. It's my pleasure to introduce today's guest speaker. He is a professional stock trader with over 20 years experience. He's taught thousands of investors how to trade the stock markets using his simple but effective and powerful techniques. He is the founder of Stockscores. Ladies and gentlemen, please give him a warm welcome for Tyler Baldhorn.
All right, I want to welcome everyone to SCATE 2012. SCATE stands for Stockscores Canadian Active Trader Expo. It was an idea that we had some time ago, and we decided that we wanted to sort of go across Canada and teach people a little bit about my approach to the stock market, which I think is not really a normal way to look at things, but it works for me, and hopefully I can help make it work for you. Now, the first presentation that I'm going to do this morning will be our longest, and it really establishes the theoretical basis for everything that we're going to do throughout the day, or throughout the morning anyway. I'm going to be talking about the basics of stock analysis. Now, when I teach a class, I typically go through this stuff in about 4 hours. We're going to condense it down into 45 minutes, so recognize that it is a condensed version of the basics. Before I get started, we always have to put up the legal, which basically says that we're here for general education purposes only. You can read all that stuff on the screen. This is DisNet is a division of Desjardins Securities, and blah, blah, blah. You won't read it there. All right, let's get started. It's a pretty exciting day. As I said, I'm going to start by teaching you some of the skills necessary to analyze stocks. By the time you leave here today, I'm hopeful that you'll at least know the method that you can use to analyze any stock, any market, in 10 seconds. And that sounds like a little bit of an impossibility, but once you get really good at this, you can actually do it in 2 or 3 seconds. There are some really simple skills that will help you understand which stocks to avoid and which stocks to consider. I'm also going to show you some of my actual trades from actually the week prior, because I did this presentation last week. And so I'll show the trade that I made about 3 weeks ago. It was a position trade that made about 25% in 5 days. It took me about 5 minutes to find that opportunity. I'll also show you how I found it, so we'll go through that process of finding out that particular trade setup. I'm going to show you some day trades as well for some of you that are more interested in that style of trading. I'll go through the results from the Thursday before I did the last presentation. I did 3 trades on that particular day, and that netted me a profit of $3,100. I'll talk a little bit about the Active 5 offer. It's an offer that they've created just for this series. You will have never seen something as good in terms of offers from DisNet, or really from anyone. And I think that it's an impressive incentive to open an account with DisNet, who are our sponsors here today. I'm also going to talk a little bit about the spring training. Every year, once a year, I have been teaching classes in Vancouver. Some of you have probably attended those classes in the past. I am doing them again here in May, on May 13th in Vancouver, May 12th in Calgary, and later on in May in Montreal and Toronto, May 26th in Toronto, May 27th in Montreal. All right. So let's get to the basics. As I said, this presentation is an overview of what I do in what I call the foundation class. The foundation class is a live class that I teach where I go through all of the components of my approach to stock trading. Risk management, when to enter, when to sell, and how to manage emotions. And they're really the building blocks for trading strategies. Whether you are a long-term, you want to hold 5 or 10 stocks in your RSP for the next 10 years, or whether you want to day trade for the next 10 minutes. The building blocks are the same. How we apply them changes a little bit over time, but there's very little change in theory whether you're a day trader or a long-term investor. And so these building blocks are really important, and that's what we're going to go through now. I have 4 pillars in my approach to the market. Pillar number 1 is the entry decision. And to understand that, we have to understand first why prices change. Why do stocks go up? Why do stocks go down? And the basic concept behind price itself is that price is the present value of future earnings expectations for the company. So obviously businesses are in business to make money. And as a shareholder, you are an owner of that business, and your interest is in seeing that company make money. Now, it doesn't matter what they made in the past, because if you own the stock today, you want to know what they're going to make in the future. And the job of the stock market is to figure out what companies will make in the future. Now, if you have a new company, they may not make anything right now, but eventually there's an expectation that they will make money. On the other hand, if you have an established company like Microsoft, they're obviously making money every day selling their services and products. And the job of the stock market is basically to argue about what those earnings are going to be. And the reason prices change is because investors get new information that changes their understanding of what the company will make in the future. So if we have a little gold mining company based here in Vancouver, and they discover a big deposit of gold, well, then they have changed their ability to make money in the future, and therefore we would expect the price of their stock to jump higher. And the market is essentially a place where investors, buyers and sellers, are arguing about what those future earnings will be. Buyers buy because they think the earnings are better than the market is priced in, and sellers are selling because they think the earnings are going to be worse than the market has priced in. Now, obviously, there's a lot of uncertainty in that calculation. We're making a guess about what companies will make. And, there's an entire industry built around trying to make a good guess. The brokerage houses in New York and Toronto and all over the world really have analysts who spend a lot of time trying to figure out what those earnings will be. And because there's so many people doing that, there is this notion that the market is efficient. What that means is that it prices in all available information almost immediately. And by being efficient, the price that you see a stock trading at any moment is a reflection of thousands, if not millions, of people who have evaluated that company in some way. Now, some people evaluate companies by looking at what they do, the business, the management, the balance sheet, the income statement, cash flow, debt to equity ratios, all these sorts of fundamental methods for analyzing stocks. And then there are other people who look at the trading activity itself and how is price moving and looking at stock charts and that sort of thing. That's referred to as technical analysis. Some people look at stars and astrology and try to figure out where stocks are going to go based on that. There's actually a pretty famous guy who has actually gotten out a bad track record using astrology, although I think he just uses astrology for marketing and everything else. He's actually doing some good analysis. All right, so our job today is to understand how to make good entry decisions, but beyond that, there are other skills that you need to trade effectively. And I would say that the entry decision is the third or fourth least important of my 4 pillars. Perhaps the most important is risk management. Because we have to recognize that we will not always be right in the stock market. The stock market is an uncertain game. It is not a science. Has anyone here been right 100% of the time in the stock market? Okay, well, at least you're honest. Anyone here been wrong 100% of the time? Okay. You know what? It doesn't matter if you're right more than you're wrong, as I'll talk about later. What's important is that you understand how to manage risk. effectively. And that means knowing what to do when you are wrong. Because you will be wrong some of the time, and risk management is about having a plan for dealing with being wrong. And also, allowing yourself to profit to a maximum potential when you are right. And I can say that in the first 8 years of my trading, I was a great stock picker, but I was a bad risk manager. I didn't really do great in the market. It wasn't until I started to understand how to manage risk effectively, size my positions, take losses when the market told me that I was wrong. It wasn't until I did all those things that I started to be successful trading. Now the third pillar is, I think, the one that is most frustrating to people, and that is the exit decision. Most of us, if you're a normal person, have FOMO. FOMO stands for the fear of missing out. It means that we hate to sell our winners, or some of us hate to sell our winners because we're afraid of what might happen. And so we watch a winner often turn into a loser. Some of us hate to have a winner turn into a loser. We have a fear of locking in the profit that we see before us, and so some of us will sell those winners too early. It all comes back to a fear of missing out, whether it's the profit we have today or the profit we dream about having tomorrow, and these things cause us to make bad exit decisions. It is, I would say, the most emotional part of the trading decision. And I've seen so many people say, well, I had a stock, I bought it at 50 cents, went to $15, and today it's at 30 cents and I still own it. We don't want that to happen, so we need a methodology for knowing when to sell our winners, but also when to sell our losers, because of course those will come as well. And I will talk today about how to do that a little bit. And the fourth pillar is emotional control. The stock market is all about fear and greed. And you have to learn to find mastery over fear and greed if you are going to beat the market. The best traders are the ones that don't care about the money. I've taught, I would say, over probably 2,000 Canadians how to trade the stock market over the last 10 years. And my very best students, when you talk to them, they never talk about the money. They talk about the trade, about following the rules, about playing the strategy properly. And the money is just an aside. It's, maybe a way of keeping score. And in some ways, if you approach the stock market like a video game, and the dollars in your brokerage account are simply your score, you have yourself on a path to doing better because you've taken some of that emotion out of the market. Now, there are some keys to overcoming emotion, and I'll talk about those in a moment. All right, so now we're going to get down to some skills. Now, the first thing I'm going to talk about today is something called inflection points. I read stock charts. The way that I make my decisions in the market is based on what I see happening in the market. And I do that because I believe that every little bit of information is priced into a stock. And if I can learn how to read what people are actually doing with their money, I can get better at predicting where stock price will go. And in order to read charts, you need to understand this very simple concept of inflection points, because everything derives from that. Now, very simply, an inflection point is the point where price changes direction. So if price has been going up for the last month or the last 10 minutes, it doesn't matter, and it stops going up and starts going down, we have made an inflection point top. And if the market has been going down for years, weeks, days, minutes, and stops going down and starts going up, it has established a floor. It has made an inflection point low. And these points really occur where the market's opinion changes. The stock market is a war between buyers and sellers. Buyers and sellers, every minute of every day that the market is open, are fighting about what a stock is worth. And in that war, there's changes in power between buyers and sellers. And when we see an inflection point, what we're really seeing is a change in the power struggle between buyers and sellers. And this will be a little bit more clear when we look at this chart. I've got all these red and green arrows on here. The red arrows are inflection point tops. and the green arrows are inflection point bottoms. And notice that I've drawn the arrows at places where price either stops going down and starts going up, or stops going up and starts going down. And these represent price points where opinion has changed, where the control of the market has changed. Now we can view these inflection points in a very short-term method, looking at a 2-minute chart of today's trading on Research in Motion, for example. Or we can look at it on a longer-term basis. The chart I have on screen is a daily chart of a company listed on the Venture Exchange. It doesn't matter, the concept is always the same. Where price changes direction, you have an inflection point. Now, how many of you have ever played that childhood game, Connect the Dots? Anyone? Okay, most of you have. If you haven't, go to IHOP. They always give you a free Connect the Dots game. This is Connect the Dots, because we're going to draw lines around these inflection points. And so we need to be able to see where the dots go in order to draw the lines. And that's why we start off with inflection points. All right, the next element, the basic building block of picking stocks and analyzing stocks, is the idea of support. Now, if anyone knows anything about technical analysis, you'll understand what support is. It's a price floor that exists where the sellers have said, we don't want to sell at any lower of a price. The buyers step in and say, okay, price is low enough, we think this stock is a bargain here, and we're going to start to push it up. And so we've established a floor price that essentially we just draw a horizontal line across inflection points. So if we go back to that chart, notice I've drawn a number of horizontal lines at inflection points, and those are floor prices. Now, the longer a floor price holds up for, in other words, the longer a line I can draw before it gets another one, like for example this one, is a major inflection point because it's the low of this chart going back a year. This inflection point, or probably this area of support, is less important because it only held up for a shorter period of time. Again, this one. So the longer the line you can draw, the more important that line of support is. But these floor prices are important because they represent a psychological barrier in the market. Again, remember, it's the point where the buyer said, price is too low. We don't want to let it go any lower. I'm going to step in and buy this market. And the sellers say, yeah, I don't think price deserves to go any lower. I don't want to sell at a lower price than what it's currently trading at. And you get that change in direction at these floor prices. Now, conversely, we have this concept of resistance. And as you might guess, instead of being a floor price, it is a ceiling price. It is the upper threshold of what people are willing to pay. The buyers say, okay, price is too high. We don't want to pay any more. The sellers say, hey, I'm going to take some profits at this price level. It's the highest price investors will pay for the fundamentals. It's a psychological barrier, and we can find that line by simply drawing a line across the inflection point highs. And so here you can see I've drawn some lines on the chart here at these ceiling prices. Notice we bump up against them a number of times. Here we bumped up against it twice. Finally broke through here. This one established a price ceiling that held up for probably 6 months before it was finally broken over here. Now, as you can imagine, these areas of support and resistance are important because breaks through them imply that there's some new fundamental information that justifies people paying a higher price. You know, if the market has agreed for 6 months that a stock isn't worth more than $1.50 a share, and then one day you get a whole bunch of people willing to pay more than $1.50, you have to ask, well, why are they willing to do that? And we reason that it's probably because they found some new information that justifies paying a higher price. Okay, so far we've got two of our important concepts out of the way. We use inflection points to see all these concepts, but there's 6 things that you need to understand to read a chart. So far we've done support and resistance. Now we're moving on to the third one, which is optimism. Remember I said that the market is a place where people argue about what stocks are worth? Well, optimism tells us who's winning the argument. If the buyers are winning, we have an optimistic market. And when we look at a chart, very simply, if there are rising bottoms on the chart moving from left to right, then we have optimism. So here we look at this chart, and I can say, okay, we've got all these little floors drawn on here. Well, what's the general direction of these floors? Well, at this time period, the floors are going up, so that was a period of optimism. Here we have optimism, because this low is lower than this low, which is lower than this low. Very simple. But it's important because you don't want to buy stocks unless there is some optimism. You can buy stocks if there is no optimism, but it's not a whole lot different than trying to paddle a canoe up a river. You don't want to fight the current or the mood of the market. And so that's why we need to understand optimism. And of course, we also need to understand pessimism, which is where investors are pessimistic about the company's future, and as a result, we see falling tops on the stock chart. So when we look at a chart, we say, okay, the tops are falling over time, and therefore we have pessimism. And so you can see here in this time frame, from July till January, there was a general feeling of pessimism in the market because each of these tops is lower than the previous one. More recently, in the last 6 weeks up until 2 days ago, this stock was showing pessimism. But when you get breaks from pessimism, when you switch from falling tops to rising bottoms, you're really getting a change in the mood of the market. And that's what we want to look for. All right, so now we got 4 of our 6 things out of the way. This isn't one of the 6, but this is another important concept, which is trend lines. Trend lines are like support and resistance, except that they're not necessarily horizontal. They can be rising from left to right or falling from left to right. If we look at a chart, we can connect the dots again. Remember inflection point tops? We draw a line across those tops, and we have a downward trend line. Inflection point bottoms, we can draw a line across those and get an upward trend line. We can do them on a shorter term time basis. Here's a shorter term upward trend line. Here's a relatively short term downward trend line. Okay, so they're all over the place. But they're important because they show us where the mood of the market changes. When we get breaks of trend, we get a change in mood, and that's why trend lines are important. Okay, our 5th element, price volatility. How much is price changing over time? Now remember, we're going to take these 6 things that we're going through now, and we're going to use that to analyze any stock in seconds. We're going to use that to pick winning stocks. This is a very important concept. We want to look for situations where the volatility of price change over time is compressing. If you've got expanding price volatility, let's say a stock normally trades in a $1 range over a week period, and all of a sudden it's trading over a $3 range, well, that expansion of volatility implies that there is more uncertainty about what the company is worth. So in that argument that's going on in the market between buyers and sellers, there is some uncertainty about the true value of the company. When you get compressing volatility, when volatility maybe goes from a $3 range down to a $1 range, well, now you're getting confidence about what the company is worth. Makes a little more sense when you look at it on a chart. So we've gone back to the Sandstorm Gold, and I've got, my inflection point highs were here, my inflection point lows were there. I draw a line across the bottoms, I get a line going up. I draw a line across the tops, and I get a line going down. But notice that these lines are converging toward one another. So here we have a lot more price volatility than we have over here. In fact, at this little range right here, this stock is trading in a 10-cent, not even a 5-cent range. Over here, it was trading in a 60-cent range. So there was lots of uncertainty on the left side of our pattern, and a lot of confidence on the right side of our pattern. And that implies that investors have grown more and more confident about the value of the company as they went through time. Now, if we look over on this side, we went from low volatility here to expanding volatility over there. So they went from confident to uncertain. Now, you'll see why when we put all these 6 things together in a moment, why this idea of compressing volatility is very important. Before we do that, I want to go over the final element of our 6, and that is abnormal activity. Abnormal activity is really the thing that I focus on more than anything else. It's my secret sauce in all of my strategies. And we can look at abnormal activity in terms of price change. So let's say a stock normally trades up or down 1%, and one day it jumps up 10%. Well, that implies that there's something going on there. If a stock normally trades up or down 1%, and one day it goes up 10%, it has made an abnormal gain of 9%. We expect it to maybe go up 1, it goes up 10, it made an abnormal gain of 9%. Well, why did it do that? And we reason, or we hypothesize, that the reason stocks do abnormal things is because there's significant fundamental change going on. Everyone understand what I mean when I say fundamental? I mean something in the business is better or worse. So if it's a gold mining company, maybe they found a new gold deposit. If it's a software company, maybe they are launching some new software that people really like. If it's a pharmaceutical company, maybe they found a treatment for some form of cancer. Whatever it is, when stocks trade abnormally, it's because there's something significant going on fundamentally. And we can get abnormal price gain because something good's happening. We can also get abnormal price loss because something bad is happening. And as traders, we shouldn't care because we can make money off of both. So we can also have abnormal activity in terms of volume. So a stock normally trades 1 million shares a day and trades 10 million all of a sudden. Again, why did that stock suddenly attract that much more attention? Well, we can reason that there's something going on. Now, I look at abnormal activity in terms of price, volume, but also trading range. Particularly when I day trade, I look at the range of trading action over a 2-minute period. And those little things can help me find opportunities. And I'll show you later on how I do that. All right, so we now have our 6 components. We have support and resistance, ceilings and floors, optimism and pessimism, what is the mood of the market, price volatility, are investors confident or uncertain about a company's value, and finally abnormal activity, which you see here on this screen. We had abnormal price action right here, and we had abnormal volume over there as well. Okay? So we have everything we need to now read the chart, believe it or not. You just have to get good at putting all these pieces together. So let's sort of recap where we are on this particular stock and why it was a good buy at the blue arrow that I've highlighted there. Let me just erase all this stuff. Okay, so we start off with inflection points. We draw inflection points at any price point where price change direction. Okay, so there's some inflection point tops. Here's some inflection point lows. We're going to connect the dots. And this is where you start to see patterns if you practice this a little bit. I'm going to draw a line across those tops, and I'm going to draw a line across those bottoms. I've just drawn a pattern. That pattern is called a pennant. Looks like a baseball pennant, right? Over here we have a lot of volatility, uncertainty therefore. Over here we have very little volatility, that means confidence. Tops are falling, that means pessimism. But we also have bottoms rising, that means optimism. Therefore they cancel each other out. This is a neutral pattern. We have abnormal activity here breaking us out of this pattern. It's breaking the downward trend line. It's breaking from low volatility. Yesterday, as of this day right here, the day prior, everybody said, we don't think the stock is worth more than $1.30. One day later, they're willing to pay $1.40. So there's something going on there. Look what happens. As more and more people learn about that information, the stock goes up. In this case, it goes from $1.40 to $1.90 in 5 or 6 weeks. You don't need to know anything about this company. You can just trust that the people who know the most, that analyze this company to death, who follow it very closely, when they know something good is coming, they go in and buy that stock aggressively, and all you have to do is follow it. And that's what I do. I just follow the abnormal action as long as it is from a good chart pattern. This is one good chart pattern. Now, before we talk a little bit more about patterns, I want to talk about a very important concept, reward for risk. This is how you should judge your success in the market or failure. Reward for risk. How much money do you make when you're right versus how much do you lose when you are wrong? If you buy a stock at $10, and let's say you say, I'm going to put my stop loss point at $9. If it goes down to 9, I'm going to take a loss. So you're buying at 10, your stop loss is at 9. How much risk do you have per share? $1, right? Buying at 10, selling at 9 if you're wrong. Your risk per share is $1. Now if you then get out of that trade at $12, so you buy it at 10, it goes up to 12, you sell, you have made 2 times your risk. You risked $1 per share to make $2. Not bad. How often do you have to be right in order to make money with that? A little better than 50%. When you factor in slippage and all that kind of stuff. What if you had trades where you risk $1 and you make $10? Well, now you're making 10 times your risk. So the higher the risk you achieve, the lower your probability of success needs to be. If you're right 20% of the time, but when you're right you make $10, and when you're wrong you lose $1, you actually make money even though you're not right very often. So reward for risk is very important. Let's go back to Sandstorm. On the day that we saw this buy signal, which is right here, we're breaking from low price volatility, and we have this big update. We're going to say if the stock goes back below this floor, this area of support, I'm going to sell. It makes good sense. You know, if yesterday investors were willing to accept as low as $1.25 for the stock, and today they're paying $1.40 for it, well, if something's wrong, it'll go back below the floor. If something is right, it'll keep going up. Okay? So we're buying at $1.40. We're going to plan to sell at $1.25. Our risk per share is 15 cents. Each line up represents a multiple of risk. This is one of the tools we have on Tools-Stockscores and Tradescores, the 2 websites that I own. You can draw these lines on there to tell what your reward for risk is. So at its very height, right here, it was making a 4-to-1 reward for risk ratio. What that really means is that if you sold it at that price, this winner pays for 4 losers. Right? Okay, so that's reward for risk. Now expected value takes this concept of reward for risk and applies it to a strategy. What do we expect a particular strategy to earn? So let's say you have a set of rules. You're going to buy a stock that breaks out from a good pattern on abnormal price action with abnormal volume. You have a bunch of rules, right? And you test those rules on 100 different situations, and you find that 60% of the time you make an average of 2-to-1 reward for risk. And 40% of the time you lose an average of 1 risk element. So 6 out of 10 times you make $2, and 4 out of 10 times you lose $1. How much do you make after 10 trades? Well, 6 times 2 is 12. So 6 times out of 10 you make $2. You make $12 after 10. And 4 out of 10 you lose 1. So you have a loss of 4. That means after 10 trades you're losing $8. So that has a positive expected value. Does anyone like to play blackjack? Nobody? I like playing blackjack. Blackjack has a slightly negative expected value. That's how the Bellagio Hotel can exist. If you play blackjack 1,000 hands at a time, you will lose money. Now the Bellagio, who's the house, knows that it has a positive expected value for them as the house. They know that if they deal 1,000 hands of blackjack, they will win. They don't know who's going to win the next hand or who's going to lose the next hand because it's a random event. But they know, because the rules or the odds favor the house, that they will win if they deal enough hands of blackjack. So when you have a trading strategy, you want to be the house. You want to have a set of rules that gives you a positive expected value. And you shouldn't approach the market unless you've come up with a set of rules that gives you a positive expected value over a large sample of trades. And the rules can be anything. It could be if a blue car passes your window on a Monday, you buy research in motion. If you test that 100 times, you probably won't get a positive expected value. But who knows? Maybe there's a secret strategy there. You could also say if the PE ratio of the company you follow is more than 20% less than the industry average, buy that stock. That would be a fundamental strategy. You could test it over 100 different samples, and if it gives you a positive expected value, you have a strategy worth trading. Most people don't approach the market with that mindset. They approach the market saying, well, my buddy told me about this stock, it sounds like a great company, I'm going to buy it. Or I saw a guy on BNN, and he seemed smart, he had a nice suit on, I'm going to buy that stock. Now, you could say, I'm going to buy every stock that this guy that's on BNN once a week features, and maybe you find that that strategy has a positive expected value because that particular person is a good analyst. That's not a bad strategy. I'm not saying that it's bad to follow people on TV. Just understand, first, you need to understand what their expected value of their market calls are. So we always want to look at expected value. Now, when I trade, all of my strategy rules are based on market activity. So I'll say, okay, if I'm trading, if I look at a stock and it's got low volatility, it has an abnormal price gain with abnormal volume, there's rising bottoms on the chart, I know all those things combined give me about a 70% chance of making $2 and a 30% chance of losing $1, 2 to 1. I have other strategies where I expect a much higher reward for risk, but I have a lower success rate. So I have a strategy that I do on the VIX, and it has a success rate of under 50%. But when it wins, it has big wins. So I can make 10 to 1, 12 to 1. Last week there was a trade, I think it made 14 to 1. So even though it's only wrong about only right about 45% of the time, it makes money because when it's right, it really makes a lot. When it loses, it has small losses. All right, so let's go now to chart patterns. We're going to take all of those things that we talked about and put them together. We combine support, resistance, optimism, pessimism, price volatility, abnormal activity, put it all together, and we can then see price patterns in charts. Those patterns can be grouped into optimistic patterns or into pessimistic patterns. So optimistic patterns are patterns where we predict the price movement out of the pattern will be positive and upward. And of course, pessimistic patterns, we expect the stock to go lower. Now I teach at least a dozen different patterns. We'll just touch on quickly a couple here this morning just to give you a sense of two of them. So an ascending triangle has rising bottoms, has a flat line of resistance, a ceiling on the top, and volatility is diminishing over time, and our trade entry signal comes on a breakout through resistance. So here we have a company on the NASDAQ exchange that had rising bottoms from left to right, flat top, a breakout, notice the volume jumped up, abnormal price action. That breakout occurred at $3.70 roughly, and within a couple of weeks that stock hit $5.80. Now what's going on? Why did that stock do that? Well, investors were optimistic. They believed that the stock wasn't worth more than $3 until this day. They were confident because it had low price volatility. And then finally we got that breakout, which told us that there was something new, significant, fundamentally driving that price action. If you followed that company very closely, maybe you had friends that were management of that company, maybe you were an expert in the industry that that company operates in, whatever. If you had some good information, you might have been able to predict that. Most of us can't predict that because we don't have that kind of information. But we can follow the people that do. That's all I do. Descending triangle has falling tops. Remember, falling tops are pessimism. It has a flat floor price. And again, volatility is diminishing over time. And in this case, we look to short the stock. In other words, make money from it going lower if we get a breakthrough support. So here is a chart of my favorite stock, Research in Motion. Favorite one to pick on. Anyone own Research in Motion? One person. One person that's brave enough to admit. Well, you can see here that we have falling tops. What does that mean? Is that optimism or pessimism? Pessimism. And we have a flat line of support at $13, roughly $12.50. What does that mean? Well, that's the minimum amount that investors have been willing to accept or sell the stock at, right? They say, when it gets to $12.50, I'm just not going to sell it anymore. I'm not willing. But notice how volatility is compressing over time and driving it closer and closer to that floor. Now, it's not a short sell yet. I mean, it was back here, but if it broke down through that floor, now you have investors saying, we really think this is ugly. We're willing to accept less than we've ever been willing to accept. And why is that? Because we have some new information that says it's worth even less than what we thought yesterday. What would that be? Well, maybe their new operating system, which is coming soon, isn't good. Maybe they can't sell enough of their playbook product. Who knows what it is? If you're an expert on RIM, if you're an expert in that industry, you might be able to figure that out. I can't. You probably can't, because you're probably not an expert. But when the market figures it out for us, well, then we just follow along. Now, we have some tools to help us do all of this, because, of course, there's 15,000 stocks out there. How are we going to find stocks that have these good patterns? Well, I created a tool for that. It's called the Stockscores Market Scan. It allows me to filter through the entire market on all these different filters. So I could say, I want to see a stock that has optimism. Well, how do I know it has optimism? I developed an indicator to help us with that. It's called the Sentiment Stock Score. If the Sentiment Stock Score is above 60, we have optimism, most likely. Rising bottoms on the chart. I want a stock that is breaking through resistance. Well, we can say 80-day resistance, breakout. I want a stock that is trading abnormally strong price action to the upside. Abnormal activity, we can say abnormal day out. And I want it trading abnormal volume, because that's good confirmation. Abnormal volume. I also want a stock that trades fairly actively. I could say it has to trade at least 1,000 times a day. Run the report. It goes through every stock that trades in North America. And it found for us 10 that meet those criteria. I can then look at those charts very quickly, one at a time. And you can see here, there's a stock that has rising bottoms. It was trading with low volatility, and all of a sudden on Friday, it made a big jump to the upside. Why is that? Well, you could research it and maybe figure out why, but why bother? The market told you that something good is going on. Okay, and so we can use this tool now to do our research. There's another one that looks pretty good. Everyone see the rising bottoms there? Left to right. October, there was a low. Middle of December, there was a low. Middle of January, we can connect the dots, the inflection points, and say, okay, this stock has optimism. We can also see that it has a ceiling price here at around $21.50. So over the last 7 months, no one has been willing to pay more than $21.50 for this stock. Friday, they were willing to do so. And they were actually willing to do so with enthusiasm, because the volume on Friday was higher than normal. It's a little bit hard to see that here because of this bad volume, big volume over here throws it out, but this stock was trading with abnormal volume on Friday, abnormal price gain, out of a low volatility pattern, out of optimism. That tells me that that stock has a good chance of going higher. So the Stockscores Market Scan is what helps us do that. Now, when you start trading, maybe you want to use this method, but you need to make sure that you are good at it first. I've also created a trading simulator at a website called Tradescores.com. So at Tradescores.com, you can practice risk-free. You don't have to put your money on the line as you test your ability. So on Tradescores, you can click on Make Your Trade. I can say, okay, I want to buy HLS. There, found it. Health South. Gives me a current price quote. I say I'm going to buy it at 22.63. Where should I put my stop loss? Let's blow this up again. Where was the floor price on this stock? 20. Excellent. That was the floor before it started going up. If it falls back below that floor, it implies what? Pessimism. Yeah, something's wrong. Pessimism. You know, the buyers have lost control again. As long as it stays above 20, whatever caused that breakout is still valid. So I'm going to buy it at 22.75 or 22.63, and I'm going to plan to sell at 22. There's my stop. I could write a little comment in here to say breaking out from a ascending triangle. I could put in a trading style. This is a position trade, and I'm going to use my abnormal break strategy. I've got all these different strategies in here. You can do all that, and now it will track your performance so that you can look back and say, okay, I did the HDU, it made 65% in 12 days, giving me a reward for risk of 7.95 and a trade score of 90. On the other hand, I had a loser here. I held it for 1 day, I lost a reward for risk of -1, and I got a trade score of 19. Now you can track your performance over time and see if you really have what it takes to invest your own money properly. And you can be a trader, trading stocks for the next 2 days. You can be an investor buying Royal Bank to hold for the next 6 months. Doesn't matter. The approach is the same. Okay, so those are our tools. And I'll come back to these tools later. If you really want to be a full-time trader, which is what I do, I sit in front of my screens most of the day, buying and selling things, then you might want to go to some more advanced tools like something called TradeStation, which I use. And that has a scanner built into it as well. It's not as good as the StockScore scanner, but we use it in combination with the StockScore scanner to identify those stocks that are worth day trading today, or worth swing trading, or whatever. Different strategies, lots of different things. Ultimately, you also need a way to enter your order with your broker. Now, you have different options. You can go to a web-based platform, which is nice. If you're in Mexico and you want to do a trade, you go over to the business center, punch in what you want to buy and sell on a website, and it gets the trade done. A little bit slow. Takes a few more steps typically. If you're a more active trader, time is important to you, then you might use a software-installed trading platform. So I use something called DD Extra or DD Plus, which are Disnat's platforms. And there I can fill my orders a lot quicker, and they get filled in, I think, 0.2 of a second. So they're almost instant in terms of the fill time. A new thing that Disnat launched last year is the ability to trade mobile. So you can have your cell phone and make a trade from wherever you are on your cell phone. So when I was flying to Calgary last week, I was long eBay, I think. No, I can't remember. Microsoft, I don't know. I was long some stock, got on the plane, and knew that I was going to get off the plane in Calgary before the market closed. Touched down, turned on my phone again, I'm taxiing down the runway, and I sold that stock. So I didn't have to be glued to my screen, whereas in the past, I wouldn't have been able to maybe make that trip until after the market closed. Now I can do it from wherever. I've made trades from my boat, from my mountain bike, on top of a hill beside Kelowna. You know, you can trade anywhere as long as you get a cell signal. All right, let's talk about the types of trading. Position trading is what most of you will do. It's the kind of thing you do in your RSP, your TFSA account, retirement portfolio. Typically buying a stock with an anticipated hold period of 2 weeks to 6 months. The research process to find those kinds of trades takes 10 to 20 minutes. Now you can do that process daily, you can do it weekly, you can do it monthly, you can do it some days, and some days you don't. The only way you're going to find a new trade is if you do the process. And you can research the entire market in 20 minutes. So I have a strategy that you can do on the weekends. You run a certain scan, you do it on Saturday morning, and you will uncover picks for the longer term type holds. I have a strategy that you can do daily. Come home from work, pour yourself a glass of wine, run some scans. Don't drink too much wine until you pick the stocks. And you've now set yourself up for a position trade with a little bit shorter time frame. We primarily focus on daily charts, but we also do weekly charts with this type of strategy. But it's a way for you to take control without taking a lot of time. Most people don't have a ton of time to follow the market unless you really enjoy it. And so 10 or 20 minutes a day or a week is all that people have. And that's why we've created strategies for that type of approach. Swing trading is a little bit more time. The expected hold period is shorter. We go for 2 days to maybe 2 weeks. It can take 30 minutes to 2 hours a day looking for opportunities. I have one strategy which you can do in the evenings. It takes maybe 15 minutes. Other strategies, you look in the first hour or in the last hour of the day. So it's up to you how much time you spend, but certainly swing trading takes a little bit more focus. And you're really focused more on intraday charts in either a 15-minute or a 60-minute interval. We'll show some of this stuff later. Day trading is holding stocks for less than a day, so you are in cash at night. You can do it 2 days a week, every day, whatever you like. I have some students that have 3 days a week when they can trade because their business or their job allows them to do it that way. But the nice thing is the game is over at the end of the trading day. You're out of your stocks and you go to bed in cash. And in many ways, that actually lowers the risk when you're day trading. Day trading is fairly focused. You have to be, I would say, fully focused on it when you are doing it. But it doesn't have to be all day. I have a strategy that I'm doing now because I'm quite busy with some other things, like putting on events like this. And so I only trade the first hour right now, using a strategy I call the worm strategy. Early bird gets the worm, right? And so in the first hour, I'm looking for a certain thing. I typically find 1 to 3 stocks a day, and I'm usually out of them after the first hour, just after the first hour. I'll show you that later. All right, our exit methods. We can exit using 2 methodologies. I teach 2 different methods. I'm going to give you a real quick overview because we don't have a ton of time. We can use risk multiples or patterns. So let's go look at a chart. Now remember we talked about risk multiples. These are these lines that I've drawn here. All right? So each line is drawn at a new multiple of risk. And the idea is when you close above a line, you move your stop to the line below it. Close above a line here, move your stop to the line below it. Close above this line, move your stop to the line below. And if you come back and hit that line, well then you're stopped up. Very simple. The nice thing is it takes 5 minutes a day to check where your stop should be. Come home from work, you take 5 minutes to go through your stocks and see where they are in terms of your risk-reward lines, and you just move your stop-loss point up, and now the computer systems at your brokers will take care of it. Another way to do it, which requires a little bit more skill, but it's probably slightly more effective, and that is to look at for patterns. So here we have an upward trend line, and the upward trend line got broken right there, so we sell. Why did we sell? Because the buyers lost control. The cycle of rising bottoms was broken, and therefore it's time to exit the trade. Now the final of our 4 pillars is emotional control. Hardest thing to do, manage your emotions. Why? Because we all have an emotional attachment to money. So what you need to be able to do is understand what your tolerance for risk is. How much are you willing to lose? You need to know what that is, because if you risk too much, you will get emotional and not follow your rules. So let's say you buy a stock at $10, you should sell it at $9, the market proves you wrong at $9. Let's say you buy Health South, which we just saw in the chart. We're buying at $22.50, we're planning to lose at $20. If you go into Health South and buy 1,000 shares at $22.50, and you plan to lose at $20, how much are you risking? You're risking about 10%, but in dollar terms, you're buying at $22.50 and you're planning to lose at $20, so your risk per share is $2,500 bucks. Now, if you can tolerate $2,500 losses, then you're fine. But you may say, I'm only willing to lose $500. Well, you've exposed yourself to a $2,500 loss. So what's going to happen when it gets to $20? You're going to find every reason in the world not to take the loss. Because it hurts too much. You've gone beyond your pain threshold. Has anyone got any losers in their portfolio they wish they sold months ago? Well, what happened? You couldn't handle the pain. Half the audience put their hand out. And that's because it got to that price and you said, oh, I'll just wait for it to turn around. You can't trade on hope. Hope belongs in the church and in the bedroom. All right, so you need to understand what your tolerance for risk is and trade accordingly. If your tolerance for risk is $500, you're buying a stock at $22.50 and you're going to sell at $20, your risk per share is $2.50. So how many shares should you buy if your tolerance is $500? 200 shares, not 1,000. You're only willing to lose 500, you should be buying 200 shares. Not what you can afford, it's what you can afford to lose. And that becomes part of your plan. Everyone, no matter whether you're a full-time trader or a buy and hold long-term investor, you need a plan. You need to write down your rules for when to enter, when to exit, how you will manage risk, and how you will manage your emotions. That plan should be 1 or 2 pages, not any longer. But if you don't have a plan, you don't have something to follow when you're getting emotional. And so you need to make that trading plan. When I teach people, the last final assignment in the class is to make a trading plan so that you have something to follow. All right, that is the end of the basics. So now we've got all of our building blocks. Now we're going to start to put it together. I'm going to take a quick 2-minute break just to have some water here. Stretch yourselves out and we'll get on to the next section.